Good morning, everyone. Welcome to the channel JIB and CIB Made Simple. And this is our live session number 24. If audio and video are okay, please type all okay in the chat box so that we can start our today's live session. If you are able to hear my voice and if video is clearly visible to you, please type all okay in the chat box. Very good morning to all of you. If everything is okay, please type okay in the chat box so that we can start our today's session. And today's session is based on Unit 25 and Unit 26 of BFM. We are going to discuss some important MCQs and case studies based on that. That will help you clear your concept. So if everything is okay, shall we begin? I'm just waiting for your response. Okay. Good morning. Good morning. Okay, all okay, fine. So let's get started with the unit number 25, right? So this is our session number 24. So this is the first question of today's session. I hope you have pen paper with you because we will do some numerical question also along the side. So friends, the first question is on your screen. As you can see, it is regarding. Yes. Okay, fine. Now, an investor own a corporate bond but is concerned about the company's ability to repay, right? An investor own a corporate bond but is concerned about the company ability to repay. So which financial instrument can help them manage this risk? Options are a mutual fund that invests in a varieties of company. Option B, a credit default swap that is called CDS on a specific corporate bond. Option C, a margin loan to purchase additional share in the company. And option D, an increased interest rate on the bond to compensate for the risk. So this is the question. Which financial instrument can help them manage this risk? Drop your answer in the chat. Let's see who get it right. So what do you think? Good morning. Good morning, everyone. So what do you think? Which financial instrument can help them manage this risk? That concerning about the company's ability to repay, whether the company will able to repay or not. So this is the first question of today's session. So to drop your answer in the chat. Is it A, B, C, and D? Whatever you think. Okay, fine. So let's break it down in simple terms. Okay. So what is okay? Some people are saying option B. Okay, fine. So let's understand what is the correct answer in the simplest way possible. So let's break down in the simple term. Imagine that you have lent money to a friend. Okay. So imagine that you have lent money to a friend, right? By purchasing their corporate bond. But you are worried, what if they fail to pay you back? So you decide to buy a kind of insurance, right? To protect yourself from the loss. This is where, this CDS, that is called credit default swap, right? It comes into play, right? Yes, option number B is the correct answer, right? You know about CDS? This is called credit default swap. So this CDS, CDS is like a safety net. You can call it like a safety net. You pay a small fee to another party, say a bank, and in return they promise to compensate you if the company default on its bond payment. So basically it is a way to transfer the credit risk to someone else. So this is you and this is your bank, suppose, who is offering CD. So basically what you are transferring the credit risk. So it is a way of transferring the credit risk to the bank, right? So correct answer to this question is option number B. CDS is the correct answer. Option number A is wrong. Mutual fund that invest in varieties of company. Just what is the meaning of mutual fund? Is just spread your investment across multiple company, but it does not specifically protect against the risk of single company defaulting, right? And what about option C, margin loan? What is a margin loan? See, margin loan, it means simply borrowing money to buy more share. Margin means what? You are borrowing money to buy more share. You are trying to buy more share of a company, right? So it increase your risk instead of reducing it. A margin load will increase your risk. So option C is wrong. Option D, an increased interest rate on the bond, right? So increasing interest rate may offer higher return, but it does not guarantee repayment if the company default. So this is also not correct, right? So the correct answer to this question is option number B, that is the credit default swap, right? It helps you transfer your credit risk. Now let's see the second one. All of you have answered correctly. Very good to see. Yes, yes, B is the correct answer. Very good. Now let's see the question number 2. So question number 2 is on your screen. It is also based on CDS. That is called credit default swap, as you know. So what is the question asking? Let's see. So friends, in this question, a bank buy a CDS to protect its investment in the corporate bond. Just now I have seen in the previous question that bank buy CDS to protect its investment in the corporate bond, right? So what does the bank pay to the protection seller in exchange for this protection? What does the bank pay to the PS? We call it PS, right? In exchange for this protection. Option A, the full principal amount of the corporate bond upfront. Option B, a one-time fee based on the bond value, periodic payment throughout the CDS contract, nothing, as the protection seller assume all the risk. What do you think? What does the bank pay to the protection seller in exchange for the protection? Is it A, B, C, or D? What do you think? So let's break it down in the simple term. What it means, that imagine you are a bank, right? Imagine you are a bank that hold a corporate bond. You have a corporate bond, right? But you are worried that company might not be able to pay you back, right? You are worried that company might not be able to pay you back, that company will default. You are worried that company will default, right? So what you do, you buy a credit default swap. What you do, you buy a CDS is called credit default swap, to protect yourself. But here is the key, right? Here is the key. In return for this protection, you don't pay the full bond amount, right? So basically, it is just like an insurance. What do you think the correct answer to this question? The correct answer is what I am answering. Okay, I am getting only one response. I request everyone to answer. This is a simple question, right? You can easily answer this question. So you know what will happen in return for this protection which you are getting. You don't pay the full bond amount or one time fee. Instead, what you do, you make a regular payment. Yes, correct. You make a regular payment, right? You make a regular and periodic payment, and this regular periodic payment is what we called premium, right? We pay premium to the protection seller. So bank will pay premium to the protection seller. PS, protection seller. Bank will pay premium to him, right? Similar to just like paying for insurance, right? For example, car insurance or health insurance work the same way, right? So option C is the correct answer here. Option C is the correct answer. What about option A? The full principal amount of the corporate bond. This is not correct, because that would defeat the purpose of protection. You are only paying a small premium, not the entire bond value. Option B, a one time fee based on the bond value. See, sometime a financial contract have one time fee, but CDS contract typically involve periodic payment, so this is also incorrect. Option D, nothing. So see, obviously it is not possible. Protection seller is taking the risk. Obviously protection seller is taking the risk, right? So they will charge a premium for it. So that is why option C is the correct answer. I hope that is the simplest way, simple question, right? I hope every one of you have understood why option C is the correct answer, right? Now let's see the next one. So this is the next question on your screen. As you can see, let me explain the question, what it is all about. So, friends, ABC Bank hold a large portfolio of loan to a small business, right? If you have any doubt anywhere, feel free to ask me in the chat portion, right? If you feel any kind of doubt. Now, let me come back to this question. This question is saying that ABC Bank hold a large portfolio of loan to a small business. While these loans offer potentially high return, they also carry a significant risk of default. The bank's management is concerned about the concentration of this risk in their balance sheet. Now the question is, how can credit derivative help ABC Bank in this scenario? Option A, ABC Bank can issue credit derivative to generate additional income from the interest payment. Option B, ABC Bank can enter into CDS as a protection seller, transferring the risk of default on some of its loan to other party. Option C, ABC Bank can use CD to directly invest in other company, diversifying its product line. And option D, ABC Bank can require all the small business to purchase credit derivative alongside their loan. Right. So this is the question. So what do you think? How can this credit derivative help ABC Bank in this scenario? This is the question. So I'm so you drop your response A, B, C, and D, and let me explain what is happening here. Let me explain. So let me break it down in the simple term. I hope I'm audible to you, right? I'm audible to you. My voice is clear to you. If it is okay, just type okay in the chat, right? Now let me continue. So friends, ABC Bank has a lot of loan with high potential return, right? It has a lot of loan that have a high potential return, right? But they are risky. The point is that they are risky. Yes, high return are there, but they are risky, right? Okay, fine. So, friends, if too many small business default, the bank could suffer huge loss. What is happening here? That ABC Bank has a lot of loan with high potential return, but they are risky, right? But if too many small business default, the bank could suffer huge loss. So the what the bank can do, right? So what the bank can do? So bank can use credit derivative, right? Bank can use something called CD. Bank can use credit derivative to protect themselves, right? So what do you think is the correct answer here? So most of you are answering. Let me see the answer. Uh, okay, B. Okay, fine. You are answering B. Okay. C. Yes, B is the correct answer. Because by entering into CDS, this is called credit default swap, right? By entering into CDS, ABC Bank can transfer some of its risk to another party, right? And this ABC Bank will pay regular premium. This ABC Bank will pay regular premium. Just we have seen in the previous question, right? They will pay the regular premium and they can transfer some of the risk to another party. In return, if the small business default, the protection seller compensate the ABC Bank. So what is happening here? Try to understand. So this is ABC Bank, right? And this is protection seller, right? And ABC Bank is paying premium to protection seller. And if the default happen, so this protection seller will compensate the ABC Bank, right? This is how it works. Suppose this particular company defaulted, so this protection seller will compensate to the ABC Bank. So this reduce the concentration of risk on ABC balance sheet, right? Now let's see the other option that we have. Option number A suggests that issuing credit derivative to generate additional income, right? So this does not, see, if you issue credit derivative to generate additional income, this does not reduce the default risk. What is our main problem? हमारा main problem क्या है? Our main problem is the default risk, right? And by issuing more credit derivative, our default risk will not reduce. That is why option A is not the correct answer. What about option C? It says investing in other company, right? So this is called diversification, right? आप यदि दूसरे कंपनी में इन्वेस्ट कर रहे हैं, इसे हम लोग डाइवर्सिफिकेशन कहते हैं, लेकिन ये हमारे रिस्क को कम नहीं करता. इट डज नॉट रिड्यूस द रिस्क. ऑप्शन नंबर डी सेइंग दैट forcing business to buy derivative, so that is not practical or not even legal also. So the bank should manage its own risk, not push it on to borrower. So by using CDS, by using credit default swap, right, bank can offload some of its loan risk to another institution, making it portfolio safer. So I hope all of you have answered B correctly. Very good. Let us see the next question. Let us see the next question, question number 4, right? Yes. Now this is the question in front of your screen, as you can see. So friends, let's talk about this question. A large investment bank is structuring a new investment product called CDO. That is called collateralized debt obligation, right? And this CDO will pull together credit default swap on various corporate debt to create a synthetic asset. The question is, what is the potential risk associated with using synthetic CDO that are not based on underlying physical asset? Option A, synthetic CDO offer diversification benefit similar to traditional CDO. Option B, the lack of a physical underlying asset can make it difficult to accurately value the synthetic CDO, potentially leading to inflated valuation and increased risk. Option C, synthetic CDO are always a safe investment because they spread risk across multiple companies. Option number D, there is no difference in risk between synthetic CDO and traditional CDO. So basically, CDO is called collateralized debt obligation. And this question is about if you know the difference between these two or not, whether the difference between synthetic CDO and traditional CDO is clear or not. So what do you think? What do you think is the correct answer? Drop your answer in the chat. So what is the difference between, what is the risk associated with using synthetic CDO? That is the point. Okay. Okay. Fine. So one answer I have got. I request everyone to answer. So let me simplify it using an easy to understand example. So suppose you are creating a CDO. मान लीजिए कि आप एक CDO create कर रहे हैं. आप CDO कैसे create करेंगे? How do you create CDO? So you will create CDO by by bundling together mini CDS. आप क्या करेंगे कि बहुत सारे क्रेडिट डिफॉल्ट स्वैप को बंडल करेंगे, and this is how you will create CDO, right? By bundling together mini CDS, right? So instead of actual loan or bond, you will create CDO. But here is the catch: unlike traditional CDO, synthetic CDO, so there are two kind of CDO. There is called traditional CDO, another is called synthetic CDO. Synthetic CDO, right? So this synthetic CDO don't have physical asset. They don't have physical asset, right? They don't have any physical asset behind them. So why? What it means? Synthetic CDO don't have any physical asset. It means they are based on derivative contract. They are based on derivative. I think you know about derivative contract, right? They derivative contract just they don't have they extract the value from the underlying asset, right? Underlying value. So basically synthetic CDO don't have any physical asset behind them. So behind them they are based on derivative contract, right? So this make them hard to value accurately, since there is no real bond, there is no loan to measure. So that is why their value, that means the value of synthetic asset, depends on market estimate and complex model. And you know what happened during market boom? During market boom, whenever market boom happen, right, these CDO can be overvalued. These CDO can be overvalued and create a bubble like risk. They create a risk which we called bubble like risk, right? So let me ask you a question: that would you feel comfortable in investing in a product that does not have physical asset behind it? What do you think? Yes or no? Would you feel comfortable investing in a product that does not have a physical asset behind it, just like CDO? You see, synthetic CDO have no physical asset behind it, right? They don't have any physical asset. They are based on derivative contract. So would you feel secure or comfortable in investing such kind of product? That is the question, because there is it is hard to value them accurately, since there is no real bond, there is no loan to measure. So their value depends on market estimate and complex model, and they are more prone to this inflated valuation. That is why option B is the correct answer to this question. So this question clearly differentiate between synthetic CDO and this traditional CDO, right? Yes, correct. Traditional CDO have the underlying value. Very good. Obviously, you will not feel secure, right? This is called synthetic CDO. Now, let us see why other option are incorrect. अब चलिए एक बार हम लोग बाकी ऑप्शन भी देख लेते हैं. So let's see the option number A. That option number A suggests that synthetic CDO offer diversification benefit. This is not true. This is incorrect, because synthetic CDO add risk, right? Synthetic CDO, what they do? Synthetic CDO add risk due to lack of physical asset. Since there is no physical asset in the synthetic CDO, that is why it will add the risk, right? Option number C suggests that it is always a safe investment. No, 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 this is not a safe investment, because synthetic CDO carry more risk. In the case of synthetic CDO, risk increases, right? Especially during market downturn. Suppose the market downturn, the risk increases. Option number D says that there is no difference in risk. This is completely incorrect, because synthetic CDO are more prone to valuation uncertainty and volatility. Can you write down two risks that synthetic CDO is exposed to? क्या आप एक रिस्क लिख सकते हैं जिससे सिंथेटिक सीडीओ एक्सपोज्ड है? आई एम वेटिंग फॉर योर रिस्पॉन्स. प्लीज राइट वन रिस्क विच सिंथेटिक सीडीओ इज एक्सपोज टू. यस, करेक्ट करेक्ट सागर, वेरी गुड. यस, 2008 का जो ग्रेट फाइनेंशियल क्रैश आया था, उसका मेन कारण था सिंथेटिक सीडीओ. वेरी गुड, राइट. सो आप एक कारण लिख सकते हैं, व्हाई, व्हाट इज द मेजर रिस्क इन द सिंथेटिक सीडीओ? प्लीज टाइप इन द चैट बॉक्स. सो जस्ट नाउ आई हैव टोल्ड यू, अभी मैंने आपको बताया है कि सबसे बड़ा रिस्क कौन सा है, राइट? ओके, सो लेट मी एक्सप्लेन वन ऑफ द मेजर रिस्क. सबसे बड़ा रिस्क क्या होता है दोस्तों? ओवर वैल्यूएशन का, राइट? सबसे बड़ा रिस्क होता है ओवर वैल्यूएशन का, राइट? ओवर वैल्यूएशन. और क्योंकि आप जो है, क्योंकि इसमें क्या है, व्हाट इज हैपनिंग हियर इन द केस ऑफ सिंथेटिक रिस्क, व्हाट इज हैपनिंग दैट दे डोंट हैव एनी फिजिकल एसेट बिहाइंड देम, एंड दे आर बेस्ड ऑन द डेरिवेटिव कॉन्ट्रैक्ट. So it is hard to value them accurately, and they are more prone to inflated value. They are more prone to inflated valuation. What happen, यदि मान लीजिए मार्केट में बूम आएगा ना, when market boom, the CDO can be overvalued, and especially in the case of undervalued. Suppose market downturn आ गया, ठीक है, तब इसका वैल्यूएशन करना काफी डिफिकल्ट हो जाता है. दैट इज व्हाई दिस ओवर वैल्यूएशन, दिस वन ऑफ द मेजर रीजन. राइट, नाउ लेट्स सी द नेक्स्ट क्वेश्चन. The next question is on your screen. I hope the previous question concept is clear. Synthetic CDO क्या होता है? I hope that is clear now. Let's see this question. The question is saying that Metro Bank is a regional bank, right, with a focus on a small business loan. And all these questions which I am discussing are from Unit 25 of your book. So Metro Bank is a regional bank with a focus on a small business loan. They are experiencing a strong loan demand, right? But also want to attract new depositor to fund this growth. So how can Metro Bank utilize transfer pricing to support their growth strategy? Option A, significantly increase the internal cost of debt, making them less attractive to customer. Option B, set a competitive internal transfer price for deposit, allowing them to offer attractive rate to attract new depositor. Option C, reduce the internal return assigned to loan, lowering their profit margin. Option D, transfer pricing model is not relevant for managing loan demand and deposit growth. So this is a very important question. Every time it is asked, transfer pricing. If you know it, then you can answer this question. Right? This question is regarding the transfer pricing. Transfer pricing question is a most frequently asked question in the examination, right? So you must have a clear understanding of it. आपको पता होना चाहिए कि transfer pricing क्या होता है, right? So what do you think is the correct option here? First of all, you must understand what is the meaning of transfer pricing. आपको transfer pricing पता होना चाहिए. देखिए transfer pricing क्या होता है कि ये this is a kind of pricing mechanism. This is a kind of pricing mechanism within the bank where the treasury department, treasury department, this treasury department assign internal price. This treasury department assign internal price to what? It assign internal price to deposit and loan, right? This treasury department assign internal price to deposit and loan. So the bank treasury buy deposit from branches. See what is happening in transfer pricing. I'm explaining. So suppose this is the treasury of the bank, right? This is the treasury, and they are buying deposit. They are buying deposit from branches. बैंक ट्रेजरी क्या करती है कि ब्रांचेस से ट्रेजरी खरीदती है और बेचती है किसे? एंड सेल फंड टू द लैंडिंग डिपार्टमेंट. तो जो लैंडिंग डिपार्टमेंट होता है, लैंडिंग डिपार्टमेंट और क्रेडिट डिपार्टमेंट, व्हाट एवर यू कॉल इट, दे सेल देम fund. So this internal pricing affect how much interest the bank offer depositor and how much it charge the borrower. Now in this case what is happening to the Metro Bank? आप इस केस में आ जाइए. मेट्रो बैंक के साथ क्या हो रहा है वो देखिए. What is happening that Metro Bank can use transfer pricing to fuel its growth, right? So what do you think is the correct option here? Is it A, B, C or D? Yes, B. B is the correct answer. Because by setting a competitive internal transfer pricing for deposit, right, Metro Bank can offer higher interest rate to depositor. इससे क्या होगा? यदि वो कॉम्पिटिटिव इंटरनल ट्रांसफर प्राइसिंग रखेंगे, इससे क्या होगा? दे कैन ऑफर हाई इंटरेस्ट रेट. दे कैन ऑफर हाई इंटरेस्ट रेट टू डिपोजिटर, राइट? यदि कॉम्पिटिटिव इंटरेस्ट इंटरनल ट्रांसफर प्राइसिंग रहेगा तो डिपोजिटर को हाई इंटरेस्ट रेट मिलेगा. डिपोजिटर विल गेट हाई इंटरेस्ट रेट. दिस मेक देयर डिपोजिट मोर अट्रैक्टिव, helping them bring in more fund, and with more deposit they can meet the growing loan demand, keeping their lending profitable, right? So let me ask you a question. If you were running a bank, would you offer higher deposit rate to attract more fund even if it slightly reduce your margin? आपसे एक सवाल पूछ रहे हैं कि यदि मान लीजिए कि आप बैंक चलाते तो क्या आप हाई डिपॉजिट रेट ऑफर करेंगे ताकि ज्यादा से ज्यादा फंड अट्रैक्ट कर सके even if it slightly reduces your margin? Please answer yes or no. Suppose if you are running a bank, would you offer higher deposit rate to attract more fund even if it slightly reduce your margin? What do you think? Yes or no? Exactly the same thing is in help in the happen in the transfer pricing, right? The correct answer is option number B here. Let's see other option. आइए हम लोग बाकी option को भी देखते हैं, right? Let's see some other option also. Option number A is that significantly increase the internal cost of deposit, making them less attractive to customer. See, internal cost of deposit increasing, so that would make deposit less attractive to the customer, which is the opposite. So this is not the correct answer. Option C, reduce the internal return assigned to the loan, lowering their profit margin. Yes, obviously this would shrink the profit margin and make lending less profitable, not a good strategy. Option D, transfer pricing is irrelevant. This is also incorrect because transfer pricing is very critical, right? ट्रांसफर प्राइसिंग बहुत ही इंपॉर्टेंट है, राइट? सो ट्रांसफर प्राइसिंग इज वेरी क्रिटिकल फॉर बैलेंसिंग लोन डिमांड एंड डिपॉजिट ग्रोथ. तो ध्यान दीजिएगा, प्लीज ट्राई टू अंडरस्टैंड टू थिंग्स आर देयर. ऑन वन साइड यू हैव लोन डिमांड, राइट, एंड अदर साइड you have suppose this is a seesaw. You might have seen a seesaw, right? So on one side you have loan demand and other side you have deposit growth. And this transfer pricing is very critical for balancing these two things, right? आपको डिपॉजिट को ग्रोथ करवाना है, आपको लोन डिमांड को बढ़ाना है, राइट? सो हाउ टू कीप द बैलेंस बिटवीन देम? सो देयर ट्रांसफर प्राइसिंग कम्स इनटू प्ले, right? So by using a smart transfer pricing, Metro Bank can attract more depositor, increase its funding and support its loan growth, all while maintaining profitability. Please let me know, is the concept clear regarding transfer pricing? Transfer pricing का concept clear है? Please type clear in the chat box if it is clear, right? So this is a very important concept called transfer pricing, right? So it helps you balance loan demand and deposit growth while maintaining the profitability, right? So this is how it happened. Let's see the next question. The next question, as you can see on your screen, this is a very good question, which is taken from Macmillan book, unit number 25. So let's go through the question. What it is asking? Citibank, right? So this Citibank offered a new high yield. As you can see, Citibank offer a new high yield checking account, right, with 2% interest rate. However, the current market interest rate for similar account is only 1.5%, and the bank treasury department estimate 0.25% cost for hedging market risk and maintaining reserve related to this account. Now the question is, how will transfer pricing impact Citibank profitability for the new high yield checking account? Option A, the bank earn a full 2% interest rate on the account, boosting profitability. Option B, the bank incur a loss of 0.75%, which reduce the profit margin on the account. Option C, transfer pricing only affect loan product, not deposit account. And option D, the cost of hedging and market rate is irrelevant to transfer pricing for depositor. So what do you think? So this question will clearly help you understand the basic thing. ओके ओके, सो देखिए ट्रांसफर प्राइसिंग का ये एग्जांपल ट्रेजरी वाला ही है, आपको आपको ये क्लियर हो जाएगा. ओके, सो यूजिंग दिस एग्जांपल एवरी कंसेप्ट विल बी क्लियर, राइट? So one example is in front of you, how this transfer pricing help in treasury. So using this example, it will be clear how the transfer pricing will help, right? So let us, so what do you think? So let me explain what is happening here. So what is happening here, that this Citibank is offering 2% interest on a new checking account, right? 2% interest on the new checking account Citibank is offering, while the market rate for the similar account is only 1.5%. So this means what? Citibank is paying 0.5% more than the market rate, isn't it? To attract depositor. So market rate is just 1.5% and Citibank is offering 2%. So it means Citibank is offering 0.5% more, right, than market rate. देखिए सिटी बैंक जो है 2% इंटरेस्ट रेट ऑफर कर रही है और मार्केट रेट है 1.5%. इट क्लियरली मींस दैट सिटी बैंक इज पेइंग 0.5% more. And why they are 0.5% paying 0.5% more? To attract depositor. The main reason is to attract depositor, right? So on the top of that, treasury add a cost of 0.25% for hedging market risk. This is an extra cost. So how does transfer pricing comes into play? Let's answer. So what happened in this case? This treasury department buy the deposit from the branch. What it will do? It will buy deposit from the branch at the market rate, which is 1.5%. ये ट्रेजरी डिपार्टमेंट क्या करेगी कि बैंक का जो ब्रांच है उससे मार्केट रेट पे खरीदेगी. क्या खरीदेगी? डेपोजिट. So the treasury department will buy deposit at the market rate. So let me write down here. Right? Yes, B is the correct answer here. Let me explain what will happen. This is the treasury department and this is the bank branch. Right? This is the bank branch. And what it will do? It will buy deposit. It will buy deposit at market rate, which is how much? 1.5%. And it will add the hedging cost. It will further add the hedging cost. And how much is the hedging cost? Hedging cost कितना है? Hedging cost is 0.25%, right? So it will add the hedging cost, which is 0.25%. So the effective internal cost will be how much? 1.5 plus 0.25. 1.5 plus 0.25. It will be 1.75%. Not the full 2%. और कस्टमर को कितना दिख रहा है, कस्टमर इज सेइंग 2%, राइट, कस्टमर को कितना दिख रहा है 2%, नॉट द फुल 2%. So this reduce, so can you tell me that how much profit margin reduce? Can you tell me how much is the bank profit margin get reduced because of this? Can you tell me exact percentage by which profit margin get reduced? क्या आप बता सकते हैं कि प्रॉफिट मार्जिन कितना मेरा कम हो गया? So it is 0.75, not 0.25, it is 0.75. Our profit margin get reduced by 0.75. First is 0.5. देखिए 0.5 तो पहले हम पे कर रहे थे और 0.25 हमें एक्स्ट्रा पे करना पड़ा, which is hedging. So our profit margin get reduced by 0.75%, right? So this is the cost. This reduced the bank profit margin by 0.75% because 0.5% bank was already incurring earlier. मतलब आधा परसेंट जो था 0.5% the bank was already incurring by paying more, and also this 0.25 they have to pay extra for hedging the market risk. So the total cost incurred is 0.75%. I hope that makes sense to you, right? So let me ask you a question. Would you offer higher interest rate to customer if it means reducing your profit margin but attracting more deposit? आप यहाँ पे देख रहे हैं ना, what you are seeing that bank is offering higher interest rate to customer even if it means reducing, obviously bank profit margin is getting reduced by 0.75%, right? And they are attracting more depositor, right? Bank is incurring total cost of how much? Bank is incurring total cost of 0.75%, right, which reduce the profit margin on the account. Now let's see the, so that's why option B is the correct. Why option A is incorrect? Option A incorrect क्यों है? Let's see. Option A is saying that bank earn a full 2% interest rate on account. That's it. That is incorrect because you know the bank paid 2% to the depositor. बैंक जो है 2% डिपोजिटर को दे रही है, but due to transfer pricing adjustment it does not earn the full 2%, right? Try to understand. बैंक जो है 2% किसको दे रही है? बैंक is paying 2% to the depositor, but due to transfer pricing adjustment it does not earn the full 2%. It is not earning the full 2%, right? That is the point. So option A is wrong. Option C is transfer pricing only affect loan product non-deposit account. This is not true. Transfer pricing affect both deposit also and loan also. And option D, that the cost of hedging and market rate is irrelevant to transfer pricing. That is wrong. These are very crucial. So what is happening here? Even though Citibank is offering 2% rate to attract depositor, to attract customer, so deposit rate it is offering to customer is 2%, right? Its internal cost is actually how much? Internal cost is how much? Internal cost is 1.5 plus 0.25, which is 1.75. This is the internal cost. So the difference of 0.75 reduces the bank profit margin, but they help them gain more customer, right? So this profit margin difference is how much? 0.75. So this is the profit margin. This is the profit margin, and this profit margin help them gain more customer. So is it clear now? Please type clear in the chat box if the concept is clear, right? How transfer pricing help you balance the deposit amount and the loan, right? Maintaining the profitability. Using this example, I hope it is clear. Treasury department, again, if you want me to repeat, please type, right? If you want me to repeat the concept, please type what is happening here. That Treasury department is buying deposit from the bank branch at 1.5% and adding the hedging cost, right? Okay, I'm again repeating. देखिए यहाँ पे क्या हो रहा है? I'm again repeating that. Okay, fine. This is a very important concept. Let me again repeat it. So see, to the new depositor, suppose you want to open account, suppose to the new depositor, you know, the bank is offering 2% interest. डिपोजिटर को बैंक कितना परसेंट इंटरेस्ट ऑफर कर रही है? 2% इंटरेस्ट ऑफर कर रही है, राइट? एंड नाउ व्हाट इज हैपनिंग इन द ट्रांसफर प्राइसिंग, दैट let's try to understand what is happening in this particular case. That this is, suppose this is the treasury department, right? This is the treasury department of the bank. So this treasury department buy the deposit from the branches. It buy deposit from the branches at the market rate, and what is the market rate? The market rate is 1.5%. So the Treasury Department buy deposit from the branches at market rate, which is 1.5%, right? And add the hedging cost. Further, it add the hedging cost, right? And what is the hedging cost? Hedging cost is how much? Hedging cost is 0.25%, right? So the effective cost is how much? Effective cost become effective cost become 1.5 plus 0.25, which is 1.75%, right? So this is the effective cost. And what customer see? Customer see 2%. Customer को कितना दिखता है? 2% दिखता है. And what is the effective cost? It is 1.75%. Now मान लीजिए, suppose, now try to understand one thing. How much Citibank is paying? See, market rate is how much? Market rate is 1.5%. मान लीजिए कोई दूसरी बैंक है, सपोज टू बैंक, वन इज द सिटी बैंक एंड सपोज अदर बैंक इज एबीसी बैंक. Suppose this is the other bank. So ABC Bank is just paying 1.5% on the deposit, but Citibank is paying 2% on the deposit. So it means that Citibank is paying 0.5% extra than the market rate. And why they are paying 0.5% extra? To attract more customer. सिटी बैंक जो है 0.5% ज्यादा क्यों पे कर रही है? ताकि हम ज्यादा से ज्यादा कस्टमर को अट्रैक्ट करें, राइट? So suppose I ask you, what is the how much profit margin decrease of the city bank? So this 0.5% is a profit margin which get decreased because it is offering extra cost. And also on the top of that, this 0.25%, which is the hedging cost, this is also decrease in the profit margin, right? So ultimately there is the profit margin get decreased by 0.75%. It has two components. The first component is the 0.5%, which it is paying extra, and second component is the 0.25%, right, which is the hedging cost. And this is how much the profit margin is getting reduced, right? So the transfer pricing, so basically profit margin is getting reduced by 0.75%, right? So basically what is happening here, even though Citibank is offering 2% rate to attract the customer, internal cost is how much? Internal cost is 1.75%, right? देखिए सिटी बैंक जो है कितना परसेंट ऑफर कर रही है कस्टमर को? 2%, राइट? और इंटरनल कॉस्ट कितना है इनका? 1.75%. So the difference of this 0.75%, which is the profit margin, it reduce the bank profit margin but help them gain more deposit. तो आप ऐसा समझिए, अभी मैंने आपको यहां बताया था, आई टोल्ड यू अर्ली दैट इन ट्रांसफर प्राइसिंग ऑन वन साइड वी हैव लोन डिमांड and other side we have deposit growth. So obviously the profit margin is getting reduced by 0.75%, but the advantage is that more customer are taking the deposit, right? So that is why. तो एक तरह से ट्रेड ऑफ ले रही है बैंक क्या कर रही है कि चलो 0.75% तो हमें लॉस हो रहा है, बैंक is incurring 0.75% loss, but it is gaining more and more customer in the form of deposit. Now I hope it is clear, right? Okay, fine. So I hope every concept is clear now, right? Treasury sitting FD loan rate. Yes, I hope it is clear now. देखिए बैंक को लॉस हो रहा है यहाँ पे कितने का? 0.75% का. Bank is incurring loss of 0.75%, but this loss it is justifying by saying that we are attracting more depositor, right? That is the point. So I hope that is clear now. Let's see the next question. The next question is on your screen. This is another question based on transfer pricing, as you can see. Because transfer pricing question most frequently asked. So the question is, ABC Bank offer various loan product with different maturity, right? So they are concerned about the potential impact of rising interest rate on their profitability. So the question is, how can ABC Bank leverage transfer pricing to manage interest rate risk associated with different loan maturity? Set a uniform internal transfer pricing for all loan regardless of maturity. Set higher internal transfer pricing for longer term loan reflecting the greater risk of interest rate fluctuation. Transfer pricing cannot be used to manage interest rate risk in banking, and the banks would offer only short-term loan to avoid interest rates. So what do you think? So question is length of repayment. How the transfer pricing plays a role here. So friends, this is the question. What do you think the correct answer? Is it A, B, C, and D? Okay, fine. January live classes. Okay, fine. I will add to your course. I think it is not added. Let me check. Okay, no issue. I will add to your course. Fine. I will add to your course. Now let's see what is happening here. Please listen to my word carefully. Even if you don't know transfer pricing, you will be able to understand, right? यदि आपको ट्रांसफर प्राइसिंग नहीं क्लियर है तो मैं आपको यहाँ समझा देता हूँ क्या होता है ट्रांसफर प्राइसिंग में. लेट अस मेक इट मोर क्लियर टू यू, राइट? This example help you clear the concept, this question, right? Basically, suppose you are lending money, right? Suppose you are lending money as a bank. You offer two loan, one loan for 1 year एंड अदर लोन फॉर 10 ईयर. मान लीजिए कि आप जो है आप एक बैंक है मान लीजिए और आप पैसा दे रहे हैं. आप एक बैंक खुद को समझ लीजिए. सपोज यू आर अ बैंक एंड यू आर ऑफरिंग लोन, राइट? टू लोन. द फर्स्ट लोन इज फॉर 1 ईयर एंड सेकेंड लोन इज फॉर 10 ईयर. नाउ थिंक अबाउट द इंटरेस्ट रेट फॉर 1 ईयर लोन. फॉर दिस 1 ईयर लोन द रिस्क इज लो. एक साल का जो लोन है उसके लिए रिस्क कम है. फॉर दिस 1 ईयर लोन रिस्क इज लो, right? And if the rate increase, you can reprice the loan next year. You can reprice the loan next year. Try to understand what I'm saying. You are offering, आप एक बैंक है, you are offering two loan. First loan have maturity of 1 year and second loan have maturity of 10 year. For the first year loan, for the 1 year loan, risk is low because मान लीजिए रेट बढ़ जाएगा. Because you think from the perspective of interest rate risk. You think from the perspective of interest rate risk. Suppose for 1 year loan, if the rate increases, right, you can reprice the loan next year. But what about the 10-year loan? What about the 10-year loan? The risk is higher because suppose interest rate increase, you are still stuck earning the low fixed rate for the next 10 year, isn't it? मान लीजिए इंटरेस्ट रेट बढ़ जाएगा तो क्या होगा? आपको कोई फायदा ही नहीं होगा क्योंकि अभी भी आप जो है पुराने रेट पे ही आपको मिलेगा, राइट? यू विल स्टिल गेट द अर्निंग एट द अर्लियर रेट, नॉट द इंक्रीज रेट, बिकॉज दीज टू आर फिक्स्ड रेट. These two loan are fixed, not floating rate, right? So this is where transfer pricing comes in. This is where transfer pricing comes in, right? This is where transfer pricing comes in. So the bank treasury department assigning higher transfer price to the long term loan. What bank treasury department will do? Bank treasury department will assign higher transfer pricing to the long term loan. Why? Because long term loan carry more interest rate risk. आप यहाँ देख रहे हैं ना, you are observing ना that long term bond or sorry long term loan, they are carrying more interest rate risk. Suppose I ask you a question, in which case, in which loan, either 1 year loan or 10-year loan, will interest rate risk will be more? Just type your answer, 1 year or 10 year. In which case interest rate risk will be more? Suppose these are the fixed rate loan, right? In which case interest rate risk will be more? Option A 1 year and option B 10 year. What do you think? So bank treasury department assigning higher internal transfer pricing to the long term loan, right? So obviously 10 year, right? Because I have just given you the example. Because in the case of 10 year, you will not be able to reprice the risk, right? So the long term loan carry more interest rate risk, making them more expensive internally, and this help the bank reflect the true cost and manage its risk exposure, right? So the correct answer to this question is obviously option number B. Option number B is the correct answer, right? Because set high internal transfer pricing for longer term loan, reflecting the greater risk of interest rate fluctuation. Why other option? Option A says that set a uniform internal transfer pricing for all loan. So this is wrong because there is no one size fit all price, right? What about option C? Transfer pricing cannot manage interest rate risk. This is also wrong, right? And option D, that only offer short term loan. This is also wrong, right? This is unrealistic. So by applying higher internal transfer pricing to the long term loan, ABC bank, the ABC bank can cover the additional interest rate risk, right? Additional interest rate risk. Second, they can maintain a balanced and profitable loan portfolio, right? They can maintain balanced and profitable loan portfolio. So is the concept clear of this question? क्या ये concept clear है? How in transfer pricing help in balancing the risk, interest rate risk basically? I hope it is. क्योंकि यहाँ पे टाइम पीरियड ऑप्शन जो हमारा सेकंड बॉन्ड है, in that case time period is more. That is why this transfer pricing help you hedge the risk, right? Interest rate risk basically. Now let's see this particular question. I hope the concept of previous question was clear to you, right? So that the three question we have done regarding the transfer pricing, and this transfer pricing is a very important from examination point of view. So now let's see the next question that we have. Okay, so the question is, the credit rating of a major company in which your bank hold a significant investment has recently been downgraded, and this downgraded risk increase the risk of potential loss to the investment. So which policy within the integrated risk management framework would be most relevant to address this situation? Option A, derivative policy. Option B, investment policy. Option C, liquidity policy. Or option D, ALM policy. These are the four kind of policy, right? And the question is, that the credit risk, the credit rating of a major company in which your bank hold portfolio has been recently been downgraded, right? So which policy would be most relevant to address this situation? What do you think? Is it A, B, C, or D? Okay, so you are saying B. Okay, fine. Let us simplify it with easy to understand example. Let us simplify it. So, friends, imagine your bank has invested a significant amount in a large company bond or share. Suppose your bank has invested a significant amount in bond or share. Now that what happened, that credit rating get downgraded. So what does it mean when I say credit rating get downgraded? Right, what does it mean? The credit rating, आपको पता है credit rating क्या होता है? So when the credit rating get downgraded, it means that company is now seen as riskier, right? Company is now seen as riskier, which increase the chance that it might default, which increase the chance that it might default. So this increase the risk of loss on your bank investment. So the risk of loss, the risk of loss get increased. So the question is, which policy handle this situation? What do you think? Is it derivative policy? Is it investment policy, liquidity policy, और ALM policy? See, यहाँ पे तो आपके सामने लिख दिया है सब कुछ, क्योंकि यहाँ पे लिखा हुआ है क्रेडिट रेटिंग, लेकिन आपको इतना लिख के नहीं दिया जाएगा. आपको यू विल ओनली बी रिटन डेरिवेटिव, इन्वेस्टमेंट, लिक्विडिटी एंड ALM. आपको चारों पॉलिसी पता होना चाहिए. These thing will not be written in your question. This focuses on dash dash dash. Only the question will ask you derivative, investment, liquidity, and ALM. That's it, right? So you must know, you must have a clear understanding of all these four policy, right? So that is the main point. So which policy handle the situation? And the answer is investment policy. Option number B is the correct answer. Why? Because the investment policy define the permissible investment that the bank can make. This investment policy, it define the permissible investment, right, that the bank can make, right? So it includes guidelines on credit rating, that minimum credit rating requirement. It includes guidelines on diversification strategy to spread the risk. आपको पता है ना, डाइवर्सिफिकेशन हम लोग क्यों करते हैं? ताकि हम रिस्क को स्प्रेड कर सकें. And also it includes the rule for handling downgraded investment, right? That is why option B is the correct answer. Let's look at other option also. बाकी option को भी देख लेते हैं, right? First option is derivative policy. So because this is incorrect, because derivative policy deals with risk management, right? Derivative policy deals with the risk management, not directly with the investment risk. What about the next option? Next option we have is ALM policy. So no, liquidity policy. This liquidity policy focus on cash reserve. This focus on cash reserve, right? And ensure that bank have enough liquidity, not investment risk. And this ALM policy, that is called asset liability management policy, it focus on the overall asset and liability management, not a specific investment decision, right? So the correct answer to this question is investment policy. तो देखिए इन्वेस्टमेंट पॉलिसी से क्या क्या फायदा है आप यहाँ देख सकते हैं. सो दिस इज द फ्रॉम टेकन फ्रॉम योर बुक, राइट? इट रिड्यूस योर एक्सपोजर. आपका एक्सपोजर कम होगा. इन्वेस्टमेंट पॉलिसी हेल्प यू रिड्यूस द एक्सपोजर, right? And also the bank can reassess the credit worthiness, and then bank can mitigate the loss, right? So these are the things covered under the investment policy, right? So I hope that was very easy question. Let's see the next one. So again, this is based on one question, based on policy. There are 4 policy which is given, and you have to take the correct one. Let's see the situation. What is happening here? The question is, your bank is expanding its international operation, which increase its exposure to the foreign exchange fluctuation, right? Okay, fine. So let me skip this question because answer is written. Let's see this particular question, because in the previous question, answer was written in the front of question. No need to go to that. Let's see this particular question. This question is a very conceptual question. You have to go through it. So let me explain what is happening here. That you have recently joined a leading commercial bank in India as a financial analyst, right? And the bank is preparing its annual financial statement. Bank is preparing its annual financial statement for the financial year ending 31st March 2024. While reviewing the draft statement, you realize that bank is using a format for, right? You realize that bank is using a format for preparation of balance sheet and profit and loss account. You can see bank is using a format for preparation of balance sheet and profit and loss account, right? That does not follow the prescribed form, right? So the format that bank is using, right, it does not prescribe, it does not align with the prescribed form in the schedule. So the CFO, the chief financial officer, insists that bank has always used this format because it provide a clearer picture. So see what is happening here. Again I am repeating, आप जो है किसी लीडिंग कमर्शियल बैंक में फाइनेंशियल एनालिस्ट के रूप में ज्वाइन किए, बैंक अपना एनुअल फाइनेंशियल स्टेटमेंट प्रिपेयर कर रही है, राइट? और आपने ये देखा कि जो you notice that the bank has used a different format for the balance sheet and profit loss account, which does not align with the prescribed form, and the CFO argue that bank has always used this format. So this is the situation. Now let's see the question. The question is, what should be your course of action in this situation? Option A, proceed with the existing format since it provides a clear picture of the bank financial position. Immediately inform the CFO that bank must use the form specified in the third schedule of the BRA. Suggest using a hybrid format that combine the bank existing format with the prescribed form, and ignore the issue as RBI has not raised any concern about the format in previous audit. What do you think? What should be your immediate course of action in this situation? आपने सिचुएशन समझा ना? सिचुएशन क्या है आपने समझा ना, कि जो फॉर्मेट है, आपको लगा कि जो फॉर्मेट है वैसा फॉर्मेट बैंक फॉलो नहीं कर रही है, और सीएफओ एज ये कर रहे हैं कि द सीएफओ इज एज्यूरिंग दैट बैंक हैज बीन यूजिंग दिस फॉर्मेट. So what do you think in this? What is most possible answer in this situation, right? So what do you think? Yes, most of you are answering option number B. Yes, correct, very good. Option number B is the correct answer. So can you name me the section? Can you name me the section of the BRA? कौन सा सेक्शन है बैंकिंग रेगुलेशन एक्ट का? प्लीज राइट द सेक्शन नेम, बिकॉज क्वेश्चन कैन बी आस्क्ड इन वेरियस फॉर्मेट. यू मे बी आस्क्ड सेक्शन, राइट? आप बता सकते हैं कि कौन सा सेक्शन है, कौन स्केड्यूल तो लिखा हुआ है यहाँ पे, स्केड्यूल इज रिटन, थर्ड स्केड्यूल. कैन यू नेम द सेक्शन in which all the commercial bank are governed? So all the banks are governed by this Banking Regulation Act 1949, right? According to which section? Please write the section name. So according to this section, banks are legally required to prepare their balance sheet and profit and loss account in the format prescribed under the third schedule, right? This ensure uniformity. इससे क्या होता है कि यूनिफॉर्मिटी रहता है. This ensure transparency. इससे क्या होता है कि ट्रांसपेरेंसी रहता है. एंड दिस इंश्योर द लीगल कॉम्प्लायंस, राइट? दिस इंश्योर द लीगल कॉम्प्लायंस, राइट? So what is the correct answer? You should immediately inform the CFO that the bank must use the form specified in the third schedule. So the section is section 29, right? So section number 29. No, section is 29, right? Remember it. Just you have to remember, this is a fact based question. जो सेक्शन है वो हमारा है 29 नंबर सेक्शन, राइट? सो इट एंश्योर्स लीगल कॉम्प्लायंस. इस सेक्शन 29 क्लियरली मैंडेट द यूज ऑफ प्रिस्क्राइब फॉर्मेट. देखिए यहाँ पे सबसे पहले क्या होता है, लीगल कॉम्प्लायंस. इट क्लियरली मैंडेट दैट यूज ऑफ प्रिस्क्राइब फॉर्मेट एज डेविएशन इज इलीगल. सेकेंड इज रेगुलेटरी कॉन्सिक्वेंस. So if the RBI or any regulatory body audit the bank, they could impose penalty, right? They could impose penalty for non-compliance. And third thing is that it ensures as uniformity in reporting. So the third schedule, section number 29, right? Section number 29, right? So the third schedule, section 29, ensured consistency across bank, right? So I hope this is the easiest question. I hope the concept is clear. Yes, 29 subsection 4. Okay, great. Right. Now let's see the next one. Let's see the next question. प्रीवियस क्वेश्चन लगता है कंसेप्ट क्लियर है, कुछ उसमें तो फैक्ट बेस्ड कंसेप्ट है, कुछ ऐसा कंसेप्ट है नहीं उसमें. चलिए आगे बात करते हैं अगले सवाल में. यू आर अ न्यूली रिक्रूटेड बैंकिंग ट्रेनी, राइट, एनालाइजिंग द बैंक फाइनेंशियल स्टेटमेंट, right, and you came across an entry that represent money raised through customer deposit, right. Some items are categorized under source of fund, and some items are categorized under application of fund, right. So let's see the question. The question is, the trainee come across an entry that represent money raised by bank through deposit, right. So you came across an entry that represent money raised through customer deposit. Now you need to classify is correctly as either source of fund or application of fund. So how should this deposit entry be classified? Option A, source of fund. Option B, application of fund. Option C, neither. Option D, both. This concept based on same question was asked in December examination. In December 24 examination, source of fund, application of fund concept was asked. So what do you think? Money raised by bank through deposit will be under which category? So think carefully before answering. Whether it is source of fund, whether it is application of fund. Okay, fine. So most of you are answering option number A. So let's, before we reveal the answer, let's break down in simple term. You know what is the meaning of source of fund? Source of fund refers to from where the bank get money. From where bank get money from, right? An application of fund means how the bank use or invest that money, right? So in this case, obviously deposit, right. Deposit is obviously the source of fund, right, because when customer deposit money into the bank receive the fund, and this deposit, this deposit, they are categorized as liability. These deposit are categorized as liability on the bank balance sheet because the bank is obligated to repay them to the customer when demanded, right. So this deposit is kind of liability, and then bank use this deposit to lend money, invest or manage liquidity. Option B is incorrect. Application of fund is wrong. Application refers to how the bank use the money. Neither is also wrong. Both is also wrong. Right. So I hope that was easiest question possible. Let's see the next one. Then trainee. Obviously, this one is application. So let me skip this question. This is the easiest question. I hope this source and this is clear. Let's see this particular question. Right. Let's see this particular question. This question is, the newly established bank has earned substantial profit in its first year. So imagine you are working for newly established bank that has an incredibly successful first year, right. It has incredibly successful first year. Now the bank has earned substantial profit and is now deciding to how to allocate them. The CFO suggests transferring a portion to the statutory reserve and adding another portion to the capital reserve. Plus, the bank has issued share at premium, right? Premium is higher than the face value, so that they need to account for that extra amount properly. So please read it carefully because I will ask you a question based on it. So this particular bank has earned substantial profit in the first year. CFO suggests that you transfer a portion to the statutory reserve while another portion to the capital reserve and some issue some kind of share at premium. Now the question is, which of the following component would not be classified under reserves and surplus in the bank balance sheet? Option is share premium, balance in profit and loss account, statutory reserves, deposit from customer. So which would not be the part of reserves and surplus in the bank balance sheet? So if you know balance sheet clearly, you can easily answer this question. So which of the following would not be the part of reserves and surplus in the bank balance sheet? So before we reveal the correct answer, let us break down into simple term. So in the bank balance sheet, so what are you answering? Let me check. So D and B, two answer I have got. Okay, fine. So in a bank balance sheet you will come across two main section. The one section is called reserve and surplus. So this includes the bank retained money, right? This include the bank retained earning, right? And the other part, is the deposit. Deposit represent the customer fund held by the bank, right? So reserves and surplus includes retained earning, it includes statutory reserves, it includes share premium, it includes profit and loss balance, right? So the correct answer to this question is option number D, deposit from the customer, right? Yes, option D is the correct answer. Deposit from the customer is not included in the reserves and surplus, right? तो ये कहां पे होगा, right? It will be included in the liability portion, right? Deposit from the customer, I just told you, right? So the deposit is classified as a liability, right? So when customer deposit money, the bank owe them this amount, which make it liability, not a surplus. तो ये deposit कहाँ पे होता है? ये deposit होता है हमारा, this deposit from the customer is a part of liability, balance sheet liability portion, right? You know what is the meaning of share premium? आपको share premium पता है क्या होता है? You know the meaning of this share premium? Let me ask you. So let me explain. This share premium, this is the extra amount received when share are issued above their face value. मान लीजिए कि face value है ₹100 and share value is suppose 110. Suppose face value is ₹100 and share value is ₹110. So this extra 10 rupees is called share premium. So this is the extra amount received when share are issued above their face value. So option B is balance in profit and loss account. So this is a part of surplus, right? Option C is a statutory reserve. As mandated by regulation, a portion of profit is transferred here in the statutory reserve. So option A, option B, option C, they would be the part of the reserve and surplus, right? Now, so what we learned from this discussion is that deposit is a part of liability, and all these things, bank on retained earning, capital reserve, share premium, these are the part of these reserves and surplus. I hope it is clear. So आपको बैलेंस शीट का हर एक कंपोनेंट पता होना चाहिए, कौन सा पार्ट क्या होता है, एसेट में क्या होता है, व्हाट इज इन एसेट, व्हाट इज इन लायबिलिटी, व्हाट इज इन दिस थिंग. नाउ लेट्स सी द नेक्स्ट क्वेश्चन. All these questions what we are discussing is asked previous year. So please I request you once more, मैं आपसे फिर से रिक्वेस्ट कर रहा हूं, यदि बीएफएम में आपको अच्छा मार्क्स लाना है, ऑब्वियसली आपको लाना ही है, तो आप प्लीज जितना भी हमने लाइव सेशन किया है, वट एवर लाइव सेशन वी हैव डन टिल नाउ, आई रिक्वेस्ट यू टू प्लीज गो थ्रू द क्वेश्चन, बिकॉज वट एवर वी हैव डन for the last 5 year from 2020 till now, right? For the last 5 year, from the last 10 paper, I have accumulated the question. मैं जो भी क्वेश्चन आपके सामने डाल रहा हूं वो पिछले 5 साल से है. तो यदि आप उतना प्रैक्टिस कर लेते हैं, if you practice that much, I assure you that 50 marks will be easier for you, right? So again, please, just 2 months is left for your BFM examination. So what I would suggest that please start with the lesson number 1, start with the session number 1 and start going through the question. Try to solve on your own. आप खुद से ट्राई कीजिए सॉल्व करने का. And if you have any doubt, you can go through the recorded live session. आप recorded session से जा सकते हैं कहीं भी आपको डाउट हो तो, right? But make sure that you go through each and every question which I provided in the live session. They are super important. Now let's come back to this question, right? So the question is, imagine you are working in a bank financial team, right? At the end of the quarter, your team record interest accrued but not yet paid on the customer deposit, right? Now during an audit, what happened? The auditor asked, how should this interest be classified in the bank balance sheet? How should this interest accrued but not due be classified in the bank balance sheet? Option A, it is recorded as asset under the interest earned. Option B, it is recorded as liability under other liability and provision. Option C, it is classified under reserves and surplus as retained earning. Option D, it is not recorded since it is not yet due for payment. What do you think? Yes, yes. Lakshman, what I will suggest that you will see a folder in the course. आपको एक folder मिलेगा. You will see a folder in the course where it is a live recorded session, and you can watch the video of all that particular folder. In that particular folder of all the previous video, right? You will see a folder in your course, right? And I think some video are remaining. I will add them also. ठीक है, मैं उसे भी add कर दूंगा. So let's come back to this question. What do you think? There is a correct option here. So okay, okay, fine. So friends, what is happening here? The point is interest accrued but not due. What is the meaning of this interest accrued but not due? You know the meaning of it? It means that bank owe interest to a depositor but has not paid yet. It means bank owed interest to its depositor. Bank owe interest to its depositor but had not paid yet. But had not paid yet. Bank had not paid yet. So it is a kind of obligation for the bank. It is a kind of obligation for the bank, right? So that is why it is treated as liability, right? Until the actual payment is made. So on the balance sheet, it is recorded as the other liability and provision. So option B is the correct answer. So whom? So let's see who of you have answered B. So all of you have answered D, A, C. No, no, no. Answer is B, right? Because you know what is the meaning of interest accrued but not due? Interest accrued but not due means what? That the bank owe interest to the depositor but had not paid it yet, right? The bank owe interest to the depositor but not paid it yet, right? So since it is a kind of obligation, so it is treated as liability until the actual payment is made. So on the balance sheet it is recorded as other liability and provision, right? Let's see option number A. आइए पहले ऑप्शन नंबर ए की बात करते हैं. ऑप्शन नंबर ए कह रहा है इट इज रिकॉर्डेड एज एन एसेट. It is recorded as an asset under interest earned. So this is wrong. This is wrong because you know accrued interest payable is a liability, not an asset. Option C, it is classified under reserves and surplus. So this is this is also wrong. This is not a part of bank profit or surplus. It is an obligation. And option D, it is recorded since it is not yet due for payment. Even though it is not yet paid, the bank still owe it. The bank still owe it. It must be recorded. So it must be recorded. It must be. It not see what I'm trying to say. Even though it is not yet paid, the bank still owe it. So it must be recorded. So remember, accrued but unpaid interest is a part of liability and it is recorded under the other liability and provision section, right? Is it clear? Is it the concept clear? Because such type of question will be asked, and this is from unit number 26. So you will see the first pages of unit 26. You should know the every part of asset. आपको asset का, liabilities का, आपको other liabilities and provision का हर एक का part पता होना चाहिए किसके अंदर क्या आता है, right? So fantastic job to those who got it right. And if you did not get it right, don't worry. This is all the part of the learning process, right? So the next time you review a bank financial statement, you will confidently know how to classify interest accrued but not yet paid. Keep participating, right? Your answer make the session fun and insightful. Now let's see the next question. The next question, as you can see on our screen, this is the question. So the question is, that imagine you are working in the finance department of a large commercial bank with branches all across India. At the end of financial year, you notice that some branches have excess fund, right, and other are short on liquidity, while other are short on liquidity, right. To balance the fund, bank record inter branch transaction under the inter office adjustment account. But here is the catch. The catch is that you spot a credit balance, right? The catch is that you spot a credit balance in this account on the balance sheet. You spot that there is a credit balance in this particular inter office adjustment account on the balance sheet. So the big question is, what does this credit balance indicate? Option A, the bank has outstanding payment to its customer. Option B, the bank branches have settled all their interbank transaction. Option C, the bank has more liability than asset across its branches. Option D, some branches have surplus fund, creating a net payable position to other branch. What do you think? So let's see who can crack this question. Drop your answer in the chat. Is it A, B, C, or D? So basically, how to show this credit balance? That is the point. Okay. So please, I'm waiting for your response. Just type whatever you think is correct. Right. This is a learning process, right? So once we understand the concept, So the point here is no inter-office adjustment account, right? The point here is the inter-office adjustment account. It record the transaction between different branches of the same bank. So suppose this is a branch number 1, this is branch number 2. So the transaction between these two branches will get recorded in the inter-office adjustment account. So if suppose there is a credit balance, what does it mean? It means that some branch have extra fund. It means some branch have extra fund, right? That means it is surplus, and these branches are in net payable position. And these branches, they are in net payable position to other branches with a shortfall. So this is the part of bank internal fund management to balance liquidity across branches without external borrowing. So bank did not need to borrow externally. So this is a part of bank internal fund management, right? So the correct answer to this question is what? Let me know in the chat. Yes, D. Very good. D is the correct answer. Very good. D is the correct answer. So this credit balance means some branches have surplus fund, creating a net payable position. Why other options are incorrect? Let's first talk about option number A. Option number A is suggesting that a bank has outstanding payment to its customer. This is wrong, because this refers to the external liability, not inter branch adjustment. So this outstanding payment to its customer is a kind of liability, not the inter branch adjustment. Option B, the bank branch have settled all their interbank transaction. This is wrong, because the credit balance shows an unsettled inter branch transaction, not complete settlement. Had there been complete settlement, credit balance would not be there, neither credit balance nor debit balance. Option number C, the bank has more liability than asset. So credit balance indicate payable position between branches, right? Not an overall imbalance of asset and liability. So what we learn from this question is that credit balance simply means some branches are having surplus fund, right? And they are in net payable position to other branch with deficit. So this is the part of internal liquidity management of the bank to manage fund effectively, across the bank, right? So that is the correct answer to this. Now let's see this particular question. I hope the concept was clear regarding the previous question. So let's see this question. So friends, the question is, as you can see, imagine you are working at regional bank X. You are working at this regional bank X, which operate in a market where interest rate is rising, right? So here is the situation. The bank offer 5-year fixed rate loan to its customer, but it fund this loan by using 1-year short-term deposit from its customer, right? So here is the issue. So here is the issue. What is the primary risk that this mismatch exposed to? Credit risk, liquidity risk, interest rate risk, or foreign exchange risk? What do you think? I think we have already discussed this question. I'm just checking whether your concept is clear or not, right? So what kind of risk here the bank is exposed to in this situation? So I think we have discussed this question previously. Just let me know whether the concept is clear or not, right? What kind of risk is the bank exposed to in this particular case? So basically, what is happening that deposit. Okay, so you are saying liquidity risk from deposit withdrawal. I want everyone to respond. I am waiting for all of your response, because this is the easiest question possible from BFM. And if your concept is clear or not, that is what I'm checking. Whether you understand all the kind of risk clearly or not, whether the differentiation of this risk are clear or not. So friends, that what is happening, that deposit rate reset annually, right? This deposit rate, it will reset annually, right? This will reset annually, right? So since the deposit rate reset annually, so they increase faster in the rising rate environment, right? So they will increase faster in a rising interest rate environment. And now the loan rate remain fixed for 5 year, right? So what will happen in such case? Can you answer now? Okay. So in this case, what will happen? That bank net interest margin will shrink, right? It means profit are squeezed, right? So bank has a maturity mismatch between assets and liability. This is called maturity mismatch, right? As you can see, 5-year loan and 1-year deposit. So this is called maturity mismatch, right? So its loan are at fixed rate for 5 year. It means their interest income stay the same. However, if deposit are short term and repricing annually, so the bank pay more on deposit but continue to earn the same on fixed rate loan, and this includes the NIM. You know what is NIM? Net interest margin. Can you write down the formula for NIM in the chat box? What is the formula for NIM? I hope you know it very well, right? So obviously what will happen? Net interest margin will get reduced, and obviously the profitability will get reduced, right? The profitability will get reduced. So this is called interest rate sensitivity risk. Option number C is the correct answer, right? So it refers to the risk that the bank profit are impacted by the changes in the interest rate. In this case, because the bank liability reprice faster than the asset, so that is why it loses out. And managing this interest sensitivity risk is the core part of ALM, asset liability management. So that is the point. So I hope that is the easiest question possible. Let's switch to the next question. Right. So let's try to solve this question. So friends, question, as you can see, it is asking you, imagine you are working at an insurance company Y, right, which hold long-term corporate bond. This insurance company hold long-term corporate bond as an asset, right? What is the purpose of this bond? So the purpose of his bond is to match its pension liability. Now here is where the things get tricky. Suddenly, several bond issuer get downgraded. Suddenly, several bond issuer get downgraded. On the top of that, there is a wave of unexpected early pension withdrawal. Right. So the question is, which two ALM objective are the most compromised here? Option A, managing liquidity risk. Option B, uh, optimizing risk reward ratio. Option C, assessing credit risk. And option D, aligning currency exposure. So this question will is checking your this question is checking whether you understand ALM objective clearly or not. ALM, asset liability management, right? So again, I am repeating what is happening here. Suppose you are working at insurance company Y, right? And this company hold long-term corporate bond, which is a kind of asset. The purpose of this bond, to match it pension liability. But what happened? Several bond issuer get downgraded, right? On the top of that, there is a wave of unexpected early pension withdrawal, right? So the question is, which two ALM objective are compromised here? So managing liquidity risk, or so here more than one option will be correct in this question. More than, because two ALM objective are given, right? So more than one option will be correct. Either it is A and B, B and C, C and D, A and C, something like that, right? So can you think about which two ALM objective are most compromised? So two option will be correct because two ALM objective are given, right? So let me explain. Let me explain what happened in this particular case. So first thing you see option number A. So A and C. Okay, very good. A and C, great. Very good. Nice to see your answer. Very good. Because it shows that you have conceptual understanding. Yes, A and C are correct. Right. Very good. Why A and C are correct? Let me explain. The first thing is that, managing liquidity risk. When unexpected pension withdrawal happen, what is happening? Unexpected pension withdrawal is happening. So the company need more cash. This insurance company will need more cash, right? So since it money is tied up in the long term bond, where money is tied up, it money is tied up in the long term bond, right? So it will face liquidity shortfall. It will face liquidity shortfall, right? So this means company may need to sell asset at loss to meet its obligation, which is risky. So this is the first objective of ALM which is compromised, which is managing liquidity risk. So remember, managing liquidity risk is a very important objective of ALM, right? So when this unexpected early pension withdrawal, like you can think of the bank. Suppose some many customer come back to take their deposit back. So obviously bank is exposed to this liquidity risk, and ALM objective is to maintain this liquidity risk, right? So bank will need more cash than expected, and since money is tied up in the long term corporate bond, so it will have to sell it asset at loss. Now let's see option number C, that is assessing the credit risk. So bond is downgrading. You see here is the point, downgrading of the bond. So the bond downgrade means the company in which insurer Y invested are now riskier, right? means that particular company in which this insurer Y has invested is now getting riskier. So this reduce the value of the bond and make them harder to sell. It also increase the default risk. So it compromise the company asset quality. And this credit risk is one of the assessing credit risk is another objective of ALM, right? So option A and C are the correct answer. Managing liquidity risk and assessing credit risk, because two things are happening here. Bond is also downgrading, and the second thing is unexpected early pension withdrawal. What about option B? Optimizing risk reward ratio. So while this is indirectly affected, it is not the primary issue here, right? The main problem here is the failure to maintain liquidity and asset quality. What about aligning currency exposure? So this deal with the foreign exchange risk. This deal with the forex risk, which is irrelevant here. So what we learned from this question is that ALM has two core objectives. First is the liquidity risk management, right? First objective is the liquidity management, and the second objective is the credit management. So question can be asked that which of the following is not an objective of ALM? You must remember liquidity risk management and credit risk management. These are the two main objective of ALM, right? And in this case, what is happening? The company has struggled to meet sudden withdrawal due to long-term asset holding, because you see it is holding long-term asset, and sudden withdrawal this bank is unable to struggle to meet. And the second thing is credit risk management. The bond is downgrading, reducing the asset quality, increasing the risk of default, right? So that is the point. So this question help you understand what are the two ALM objective, right? Now let's see this particular question. The question is in front of your screen. I hope this is the last question of today's session. Let's try to understand. Imagine you are working at the XYZ bank, right? And the management team is evaluating the bank ALM, bank asset liability management. Here is the situation. The bank has a positive gap in its balance sheet, right? The bank has a positive gap in the balance sheet, right? However, due to unexpected maturity mismatch, the bank is facing short-term liquidity constraint, right? Bank is facing short-term liquidity issue. Again, I am repeating that you are working at XYZ bank, and management team is evaluating bank ALM strategy. Management team is evaluating bank ALM strategy. Bank has a positive gap. However, due to unexpected maturity mismatch, bank is facing short-term liquidity constraint, right? Now the question is, given XYZ positive gap, which of the following interest rate movement would be beneficial for the bank profitability? Since it is given that it has a positive gap position, so which interest movement will be beneficial for bank profitability? Option A, rising interest rate. Option B, declining interest rate. Option C, interest rate remain unchanged. And option D, any interest movement would have no impact on profitability. What do you think? So you know what is the meaning of positive gap? आपको positive gap का meaning पता है? Then only you can answer this question. If you know the meaning of positive gap, then you can answer this question. You know what is the meaning of positive gap? See, there are two things. One is called rate sensitive asset, other is called rate sensitive liability, right? So rate sensitive asset, RSA. Some example of RSA are loan. Some example of RSA are investment. This is called rate sensitive asset. And there is something called rate sensitive liability, RSL. Some example of RSL is deposit. Can you give me some other example of rate sensitive liability other than deposit? Right. So why is it called rate sensitive liability? Because these kind of these things are very much exposed to the rate, deposit rate, right? This is called rate sensitive liability. So this positive gap means what? This RSA is greater than RSL, right? Rate sensitive asset is larger than the rate sensitive liability. That means more earning asset than interest bearing liability. But what happened? Due to unexpected maturity mismatch, the bank is facing short-term liquidity. So, if the bank has a positive gap, which interest rate movement would benefit its profitability? So that is the point. So what do you think? Rising interest rate, declining interest rate, or nothing? Interest rate remain unchanged? Is it A, B, C, or D? Yes, A is the correct answer. Yes, very good. A is the correct answer. Why is the correct answer? Because with a positive gap, it means bank has more RSA than RSL, right? Bank has more RSA than RSL. RSA means rate sensitive asset. RSL means rate sensitive liability. right? Like for example, I've given you loan and investment are RSA, and deposit is a kind of RSL, right? So one thing I want to ask you, please answer my question. Whether this, whether let me ask you a question. Whether this current account is RSL? Please answer. Whether current account is RSL? Yes or no? Current account is RSL? Yes or no? Let me check your understanding. Whether current account is RSL? Current account, it is a kind of deposit, right? Whether it is RSL, rate sensitive liability, yes or no? Yes, obviously no. Correct answer is no. Why? Because see, current account is not an RSL, rate sensitive liability. Because current account does not yield you any kind of interest. There is no interest on it on the current account, right? So, so whenever current account is written, you don't get any interest on the current account. You get interest on saving account. You get interest on fixed deposit. So they are the kind of RSL. But current account is not a kind of RSL because they are not sensitive to the rate, right? You on current account, bank don't pay any interest. Is it clear? So current account is not a kind of rate sensitive liability, right? So you must, so one numerical question is asked where they give you some deposit and they give you to identify which one is the rate sensitive liability and which one is rate sensitive asset, right? So you must know this thing, that which one is a rate sensitive asset and liability. So all deposit are not rate sensitive. Now let's come back to this question. In this case, what is happening, that RSA and RSL. So positive gap means RSA is larger than RSL, right? And suppose interest rate goes up. Suppose interest rate goes up, what happened? The bank loan and investment get repriced at higher rate, generating more income. In this case, suppose interest rate goes up, what will happen? Bank loan, bank investment, right, get repriced at higher rate, right? Suppose present rate is 8%. Now since interest rate is going up, now it will be 9%, right? So all the bank loan and investment get repriced at higher rate, and obviously this will generate more income for the bank, because this is the use of the fund, application of the fund, right? Meanwhile the liability like the customer deposit get repriced too, but at slower rate. Try to understand this. This is very important thing. So since RSA is greater than RSL, so since interest rate is rising, so both are getting repricing. Both are getting repriced. RSA also and RSL also. But the rate of RSA repricing is higher as compared to RSL. Liability also get repriced, but at slower rate, right? But at slower rate. And this is getting repriced at higher rate. So ultimately, this increase the bank NII. What is NII? Net interest income. What is net interest income? What is the formula of net interest income? Net interest income is RSA minus RSL. RSA minus RSL. This is called net interest income. You know NII? Yes. So yes, very good. Current account, current account is not a rate sensitive liability, because suppose tomorrow interest rate increase. So if interest rate increase, since bank is not paying any interest on the current account, so it is not a kind of rate sensitive liability, right? Try to understand it. So you must know whether a thing is okay. Now one more question I want to ask you: whether cash in hand, whether cash in hand is rate sensitive liability, yes or no? Sorry, rate sensitive asset, yes or no? Cash in hand is a kind of asset, but whether it is rate sensitive asset, yes or no? Please answer. Let us check your understanding. Whether cash in hand is a rate sensitive asset, yes or no? So basically what is happening in this case, that if interest rate increases, right, ultimately bank NII increase. So my question is cash in hand, whether it is rate sensitive asset, yes or no? So most of you are saying yes. Please think twice before answering. Cash in hand. So how to identify whether something is a rate sensitive asset or not? So suppose interest rate increase tomorrow. What will happen to the cash in hand? Whether it get affected or not? Please tell me. So rate sensitive means what? Rate means interest rate. So whether something is sensitive to interest rate, that is called rate sensitive asset, RSA. RSA means rate sensitive asset. So suppose cash in hand is a kind of asset for the bank. It is kind of fixed asset. So obviously it is not, right? It is not a rate sensitive asset. So a numerical question will be asked. Try to understand. A numerical question will be asked. They will ask you to calculate NII. They will give you, okay, bank has suppose 50 lakh cash. Bank have suppose some kind of loan, some loan. Suppose they will give term loan of suppose 80 lakh. Or suppose another investment the bank has is suppose 30 lakh. Another, these are the kind of assets. And on the liability side they will give current account, suppose current deposit is 20 lakh, or saving deposit is 30 lakh, or suppose a fixed deposit is 20 lakh, suppose some data like that. Now they will ask you to calculate, you have to first identify which is RSA and which is RSL. So remember, this cash in hand is not an RSA. This current account is not an RSL. So you should not take these two into account. Only those assets and those liability are rate sensitive, which are getting influenced by change in interest rate. They have only to be considered. I hope that is clear now, right? Is it clear? Right. So I hope that is clear, that what is rate sensitive asset and rate sensitive liability, right? Cash in hand is not a rate sensitive asset, and this current account is not a rate sensitive liability, right? So friends, I hope this question concept is clear, that what happen if interest rate rise. If interest rate is rise, bank asset will be repriced at higher rate than in liability. So this will be most beneficial, right? We will do one numerical based on it in the next session. In the next session we will do one numerical based on it, so that you can easily understand, right? So that is all for today's session, right? I hope this was helpful for you to understanding some concept, right? And the next session we will do shortly. I will inform you the detail, the upcoming session detail in the Telegram group. So I request you to please join the Telegram group. I post the update most frequently, and the PDF of this session will be available in the Telegram group. You see the file section of the Telegram group. The PDF will be available, and also the recorded video will be available in the course. Right. If you have any doubt regarding today's session, you can ask me in the group itself. Right. So that's all for today. I will continue. I will propose you the detail regarding the next session. Thank you. Thank you for all of you for joining the session. Okay, sure. I will add. I will add January live classes in your course. Right. Shortly, I will add. Fine. Thank you.